Hi, I'm Natalie Archuleta, and today I want to share with you 10 things that hurt mortgage deals. These are from an underwriting perspective, and they're not in any particular order. I'm just going to list them 1 through 10. So number 1, job hopping. It's very important when you're in the market to purchase a new home that you have a strong work history. It's the first thing an underwriter is going to look at. So if you've had multiple jobs in the last 2 years, it raises a red flag. If you've had more than 3 jobs in the past 12 months, some loan programs don't allow for that, so you might have to wait. Number 2, gaps in work history. So pertaining to like number 1, if you've had multiple jobs in the last 2 years and there is any gaps of employment between jobs, an extended gap of employment is considered typically about 6 months or longer. If you've had an extended gap, depending on the loan program you qualify for, you may have to be on your current job for at least 6 months before you can proceed with the loan process. So be careful when taking time off between jobs. That could hurt you. Number 3, previous foreclosures. So if you've owned a home in the past and you're wanting to purchase a home again, there's a waiting period for if you've had a foreclosure. So for FHA, it's 3 years, USDA is 3 years, VA is 2 years, and conventional is 7 years. So just be careful. If you've had any foreclosures, get with your loan professional, mortgage professional, and see what that waiting period is so you can proceed. The next one is number 4, and that's bankruptcies. So depending on the type of bankruptcy it is and the type of loan you qualify for, there's waiting periods. And the waiting periods for bankruptcy, it's based on typically the discharge date of the bankruptcy. So for FHA, it's 2 years, VA, it's 2 years, USDA, it's 3 years, and conventional, it's 4 years. And we have a whole chart. So that's for the most common type of bankruptcy, which would be Chapter 7 or Chapter 11. The waiting periods differ a little bit if it's a Chapter 13. So just get with your mortgage professional and you can get the breakdown of all of those waiting periods per bankruptcy type, per loan program. So number 5 is numerous open collection accounts. So really any collection accounts, you want to be very careful when you let things go into collections. It hurts your credit, and if you're in the market for a new home, that's very important. So if you have collection accounts and the balance exceeds $2,000, with some loan programs you have to either pay off all the collections if the balance exceeds $2,000 before closing, or in some cases we can take 5% of the balance you owe, and that's the total balance of all collection accounts. Take 5% and add it to your liabilities. That then can cause your debt to income ratio to go up, and it can hurt you in the loan process. So one thing I would recommend if you have collections is call the creditor, see if they would accept a lesser amount. A lot of collection agencies, they'll settle and they'll take a lower amount to just get some payment and close the account. So I would recommend, if you have collections, try contacting the creditor, at the very least set up a payment plan, and then you can proceed with the loan process. Number 6 is non-sufficient funds on bank statements. So this is an important one because in most cases we'll ask for bank statements. If you're doing a refinance and you don't have any money out of pocket that you have to pay, we won't need your bank statements most likely. But if you have cash out of pocket, closing costs, down payment that you have to pay at closing, we are going to need your bank statements, and typically we'll need your last 2 months. If you have non-sufficient funds fees, more than one, it's going to raise a red flag. The underwriter is going to wonder why. If you're struggling, to keep the money in your account, if you're going to be able to make your mortgage payment. So just be very careful on those. If you do have some on your bank statement that your underwriter, that your loan originator gets and your underwriter sees, you may be required to write a letter of explanation and explain why you had those overdraft fees. In some cases, it's not your fault. Maybe you have fraudulent activity on your bank card and it caused the problem and you got it fixed. Stuff like that can be validated. So just be careful and try to avoid non-sufficient funds fees. Number 7 is gift funds. We actually work with gift funds all the time. It is an acceptable source to help you with down payment and closing costs. However, there are some loan programs that require some money out of your own bank account. So if you're utilizing a first-time homebuyer program with down payment assistance, those programs would like to see $500 of your own money being paid towards the transaction. So gift funds are in most cases okay, but try to have some money saved for in case you utilize a program that requires it. Number 8, large increase in housing. So what this means is if you currently live rent-free with family, or if you live with boyfriend or girlfriend, and then now you're gonna have a mortgage payment of $2,000, just as an example, that can be considered payment shock. And in some cases, depending on how your loan's being underwritten and which loan program it is, it could be considered payment shock and it may not be allowed. So just be careful when doing that. A lot of programs, we require a verification of rent, which means we'll contact your current apartment complex or landlord, and we'll verify how much you pay monthly and if you have a good payment history and a good history with that landlord. So keep that in mind, be nice to your landlord and pay your rent on time. Number 9, retaining primary. What this means is if you already own a home as your primary residence, but you're vacating that home and purchasing a new home as your primary residence, but you want to keep your current home, you don't want to sell it or anything, sometimes that can cause an issue. It can cause your debt to income ratio to be too high. So in some cases, you would have to rent out the current home. If you do want to keep it, you would have to rent it out. You'd have to get an executed rental agreement so we can offset the mortgage payment on your existing home. And so that is an option that you have if you want to retain your home, but your debt to income ratios don't work. Rent it out, provide a rental agreement, and we can offset that payment in most cases. Otherwise, you would have to sell it. If your debt to income doesn't allow to keep it, you would have to sell it before closing on the purchase of your new home. So just keep that in mind. Late payments, and this is number 10, so late payments in the last 12 months. So this is important. Not only do late payments hurt your credit quite a bit, depending on what type of late payment it is, it can not allow you to move forward in the loan process. So an underwriter is going to look at your credit report. If there's a lot of late payments, they're going to wonder if you have the ability to repay your mortgage or if you're going to make it a priority. Now, if you have late payments on an existing mortgage account, in some cases that's not allowed. You would have to wait. Some loan programs only allow for 2 late payments in the last 12 months. Some don't allow for any. So just keep that in mind. If you have a mortgage, make sure you're making that payment priority. So that was it. 10 things that hurt mortgage deals. I hope you found value in this. If you're a real estate agent and you found this valuable, please comment below or reach out to me. I'd be happy to host a lunch and learn at your office or for your colleagues, and we can get more in depth on things that underwriting looks for. So thank you so much. See you next time.